Hey folks, welcome back to another episode of Malcolm on Money, where we decode some of the more complex financial topics folks tend to run into and then attempt to simplify it and make it as plain as possible. So today we're going to be talking about what to do when you inherit an IRA or a 401k from a loved one. Because with all the recent changes to the rules surrounding inherited retirement accounts, it can be tough to figure out what exactly you're required to do to stay on the right side of the IRS. So I want to start by clarifying a couple of things. First, when you inherit any sort of pre-tax retirement account, whether an IRA or 401k or TSP or 403b or 457b or something similar with letter number combination, you'll have to roll that account over into what's called an inherited IRA. And this is a special type of account that's also sometimes referred to as a beneficiary IRA. So don't let the terminology fool you, all right? This is a special IRA account that can be established at any of the larger brokerage firms, so your Fidelities and Schwabs and Vanguards and the like. And you can do this either online or by working through a financial advisor. But one of the most important things is that it needs to be in your own name and it needs to be tied to your own individual Social Security number. Plus, and this is important, inherited IRA accounts also need to have explicit wording that designates that these funds were inherited. Usually they'll shorten it to the abbreviation INH on the registration. But either way, you just want to make sure that it does say somewhere in that account titling that these funds are inherited. Then it'll also need to include the decedent's name. All right, that's the person who left you the account in the first place. And the date that they died needs to also be clearly indicated on that account registration. Making a mistake in the setup of this account could cost you big time. So be sure to take your time here and pay very close attention to the details. And if there's multiple beneficiaries listed on the same one retirement account, each one of you beneficiaries will need to establish your own inherited IRA prior to you guys distributing any of the inherited funds. Okay, so second, you will have to pay some taxes. Now, this part is somewhat up to you, where the IRS used to allow you to defer the tax bill out forever and into the future using what was once referred to as a stretch IRA. That strategy is now dead. And so you're required to take the entire balance out of that inherited IRA within 10 years of when it was established, but that's still good news. And I say it's good news because it still allows you to spread out that tax bill over a good number of years if you choose to. So for context, if you were to call up the company where that account was held, and let's say it's Fidelity, right? And you were to tell Mr. Fidelity to liquidate the entire account that your dad left you, and you want to receive the proceeds in cash as soon as humanly possible. Well, you've just committed to giving about half of your inheritance to Uncle Sam. And I'm not being hyperbolic here, even though I kind of wish I was. That's because you're first going to have to pay ordinary income tax on that money to the Fed. And you might be thinking, well, my tax rate is only 12%. Or 22%, or maybe 24%. But what you have to keep in mind is the entire amount you distribute from that account gets added to your taxable income for the year. So if you inherited $250,000 in an IRA, you've got to add that whole $250,000 to whatever income you already made that year from your own salary and whatever other income sources you normally have. So now you're up into the 30s. You're at 32, 35, 37. And we haven't even talked about the state yet. So now if you live in a state that has an income tax as well, and especially if it's one of the high tax states like California, New York, New Jersey, etc., you can see how I arrived at that 50% number. And so by paying attention to the rules surrounding these inherited retirement accounts, you'll be better equipped to avoid costly mistakes, right? Even if you said, I really need this money now, and that 10-year thing Malcolm's talking about sounds great, but I can't wait. You'd still be better off taking half this year and then waiting until January 1st of the next year to take out the other half. Also, you want to keep in mind that any inherited retirement funds that are sent to you via check will need to be deposited into an inherited IRA account within 60 days of the time that check was cut. That's the only way to avoid the IRS treating the entire thing as a lump sum distribution and all of that money getting added to your taxable income for the year. Parenthetically, there are a separate set of rules for inheriting a Roth IRA or a Roth 401k or all the other ones I listed before, but we're not going to take the time to get into those today. Just important to know that they exist, but maybe we'll do a separate video on that one at some later date if there's enough demand for it, but we shall see. All right, so anyway, let's say you've listened to this thus far and you've decided to stretch those dollars out to avoid getting crushed by taxes all in the same 1 year. And this is another place where things get a little confusing, because to this point, the IRS has told us that there is an amount that you're required to take from that inherited account each year to satisfy what's called a required minimum distribution. However, they haven't told us what that required amount is. In fact, they keep putting off clarifying what that RMD amount should be. So for now, if you inherited an IRA within the last couple of years and haven't taken an RMD, no harm, no foul. They basically keep coming out and saying, we've forgiven the previous year, and we'll let you know when we determine what that required distribution looks like. But what we do know for certain is that you will be required to zero that account out by year 10. So the prudent approach here would be to spread those distributions out equally across 10 years, and then at least you've done what you could to keep as much of it as you could away from the IRS. But there is also a slight caveat here, because, let's say you're considering going back to school in a couple of years, or you're considering going on sabbatical for a few months next year and your income's going to go down, or you're going to stay home with your kids for the next few years, or anything else that you can foresee that would make your income artificially low for a number of years at some point in the near future within that 10-year window we're talking about. In that case, knowing what we know right now, it might make sense to plan your distributions to coincide with those years while you have little to no income coming in, and then take advantage of the opportunity that way. Every situation is different, so it's best to stop, take a beat, and just consider all the ways in which this money can help you both today and in the future. Then consider which of the options I've just laid out here might help create the optimal situation for you personally. Nonetheless, the goal here is to make sure that as many of these inherited dollars make their way into your hands instead of falling into the hands of the IRS. All right, folks, that's it for today's episode. Hopefully you learned something new and feel compelled to like or subscribe and all that good stuff you're supposed to do on here. But more importantly, I hope you find this information valuable enough to share it with someone else you know. And if you'd like to receive more content like this directly into your inbox every week, then be sure to sign up for the Malcolm on Money newsletter at the address in the show notes below. And if you'd like to send us any comments or concerns or kudos or ask a question directly, feel free to shoot us an email at hello@malcolmethridge.com. Thanks for watching.